Here's your guide to cryptocurrency technical analysis. In this video, we'll go over the core techniques that we can use to analyze crypto charts and give ourselves the best chance for profitable trading. Hey guys, James here. We can use the tools I'm going to discuss in this video to at least give us an edge with our trading and give us a better chance of understanding when and why to enter into certain trades. I'm going to be touching on candlestick charts, drawings, indicators, and how we can use certain chart patterns to make better trading decisions. If you want to go back and watch a section of this video, see the timestamps in the description. First, we're going to talk about candlesticks and why you should use candlesticks when you trade. These are candlesticks, so I'm going to go through what these actually mean, why one is red, why one is green, what is the colored in part or the actual candle, and what is this part, and this is known as the wick. So what exactly do these mean and how can we read these and use these to get more information about our trades? Let's come to the live Bitcoin chart. You can see I'm looking at what is called a candlestick chart right here. Each of these candles tells me something about the trading in Bitcoin. We can see that we have a lot of red candles right here, and then there are some green candles as well. What do these candlesticks actually mean? So firstly, each candlestick represents a period in time, and you can on the chart change this. You can see right now I'm looking at a 1-day candlestick. That means that each candlestick represents 1 day, 24 hours of time, and we can see each one here. So this is a day and another day and another day. You can also change this though very simply and come up and put a 4-hour candlestick chart on there. That means each one of these candlesticks is just 4 hours. So let's look at what these candlesticks actually mean. Firstly, we have a red candle, red for down and green for up. So we know that if a candlestick is green, it means the price appreciated and went up during that time period. If the candlestick is in red, it means the price actually fell during that time period. The candle in the middle, and this is the colored in bit, this tells you where the opening price was and the closing price was during that time period. So as we can see here for the red, we opened at this price. And then at the end of that time period, let's say this candlestick is an hour. So we opened here on the hour, and then at the end of the hour, the price was right here. So that is the end of the hour, the end of the candlestick. Then we move on to the next new candlestick. What is this part though here, this kind of wick right here? Well, this tells us the intra-time period trading. So what this means is that the price opened up right here. That was the entry price. During the time period, what happened is that the price went up here to this level. It also fell all the way down here to this level right here, as you can see. So during the time period, the price was actually from this level all the way up to this level. However, the opening price was right here, and then the closing price was right here. This just tells us that during the time period, buyers tried to push the price up, sellers tried to push the price very lower, and it actually settled here for the closing price. This can tell us a lot of information about certain trades and how traders are moving the price. For the bullish candle, we know that the opening price is obviously right here because the price moved up to the closing price. So this is the closing price up here. The price actually went all the way up to this level, but it did sell off a little bit and come down to this level for the close. This is what's known as a bullish engulfing pattern. That just means that the bullish candle engulfed this one. So the bullish move to the upside engulfed this bearish move to the downside. Now, when you're a trader, you can actually look at this and say, well, if there is such a bullish move in the price, that could potentially follow on to candles in the future, and then we could possibly trade on this information. Going back to the live Bitcoin chart, let's try and look at some bullish engulfing patterns. Can definitely see that here. So zooming in, we have a sell-off right here and then a big move to the upside. And you can see that's a bullish engulfing. The move to the upside was so much stronger than this move to the downside. And as a trader, you may say, well, that means that buyers are coming into the market and they could push the price up further. So if you took a trade right here at this level, you would have actually made a little bit of a move there. And that's what scalpers do. And day traders do. They try and read the candlesticks and see, hey, look, traders are coming in, they're pushing the price up, and so that may carry on, and obviously that would have been a profitable trade for you. There are different types of candlestick though. So this is a bullish candlestick, as you can see. You can also move to what's called a bullish hammer, as you can see here. So now that we know what the difference is between these candlesticks, we know that the entry price actually was up here. So even though it's a down candlestick, it's not a terrible move. We can see the entry price was obviously around here. And then what happened is sellers pushed the price down all the way to this level. So that's a really bearish move. What happened during the time period is that buyers came in and pushed the price all the way down from this level all the way up. And even though the candlestick was a down move and a red candlestick, you can see that there was actually a bullish move during the time period that pushed the price way up to this level. What that actually means is that in the early part of this candlestick, this time period, sellers came in, but towards the end of the candlestick and the end of that specific time period, buyers were winning. And what you can do as a trader is think, well, is that going to continue to the next candlestick? Are they going to continue coming in? So even though this candlestick is down, we could actually see that the positive trade can continue, and that's exactly what happened here. So you can read candlesticks to try and enter your trades. This candlestick pattern is known as a bullish hammer, looks a little bit like a hammer. Next up with candlesticks though, we have something called a shooting star. Shooting stars are potentially bearish, inverted hammers, potentially not the most bullish of signs. So you can see that buyers pushed the price all the way up here, but during the time period, sellers came in, pushed it down. So potentially not that bullish, even though this particular chart has the price moving up, this isn't always the case. Then we come and look at a shooting star. It's the exact opposite of a hammer. You had buyers pushing the price up, but during the end of the time period, sellers came in, pushed that price right back down again. So we could, as a trader, potentially say, if sellers are coming in towards the end of this time period, they could potentially move it lower as well. So we can see those on the live Bitcoin chart as well. A very small shooting star you can see right here. So we had buying pressure, buying pressure, buying pressure, put it up to here. Sellers came in towards the end, made a very small shooting star, potentially telling us that it might move lower, and in fact it did. Next up, we're going to come to drawings, and there are many different types of drawings you can put on the system. First one is trend lines. These are really good graphs and they weren't made by me, so thanks to all of the publications that actually made these. A trend line is a very simple way of drawing a trend on the system, so you can see that. You can draw a trend line drawn with these two swing pivots. What does that mean? It means that you have to try and link up areas of consolidation that actually confirm the trend line. You can't just draw them on randomly. You can see a bullish engulfing candlestick pattern. You can see the trend line is actually cutting through this. This isn't really the best way. It's a little bit messy and doesn't follow the actual trend, but this is what happens with trend lines. You can never draw a perfect trend line. It almost never happens. You can see number 3, draw a trend line with bounces and bullish pin bars. Again, you just have to try and line up trend lines as best you can to give yourself a kind of level to trade off. Let's come to the 1-day chart on Bitcoin and see if we can draw some trend lines on there. So we're in a big downswing right now, but you can definitely see the trend line here. So I'm going to click on this on the left-hand side on a trend line. Now you can see you have to line up and try and connect as many major points as possible. So I'm just going to click here for the trend line, and then I'm going to carry it on up here. And you can definitely see that I can very easily touch these 3 points. I have a point right here that works, then coming up, it definitely touches here and it touches here again. So that would be what's called a trend line, and obviously telling us that Bitcoin was definitely in an upward trend there. And you can see that the chart definitely bounced off that trend line a lot of times. And it's not a coincidence that you can see this red line here. It's the 50-day moving average. We'll get onto moving averages later on in the video. It's not a coincidence that Bitcoin bounced off essentially its 50-day moving average on many occasions. And the trend line essentially is a straight line that follows that moving average. What happens when charts break out from these trend lines though? That tells us that the trend has, without a doubt, broken down. So when you're in a bullish run and things are going well, what you would do as a trader is try and buy from the trend line if you're going long. So obviously you'd buy at this level, have that move up, wait for the pullback to the trend line, buy again around here, move up, buy again around here on the pullback, and then you would buy some cheaper Bitcoin or other crypto, hoping for that to move up. But you can see when this happens and the price moves through a trend line, then you're going to have to look for other levels of support and resistance to try and find out where the price is going to go next. We will get onto that later. Trend lines aren't really that useful overall. You may want to draw a trend channel, as you can see here. Trend channels try to put a price within a channel and a range. You can't just draw a trend line and say, I'm going to get some Bitcoin exactly when it hits this, because prices don't trade like that and they may not ever come to that line. What you can do actually is draw many channels. So I'm just going to draw another trend line right here on the upper end. And what this gives us is a trend channel. So instead of having one line, we can actually try and place trades somewhere within this channel, because you can never have a perfect trade. But if you're within maybe a couple of percent like these two lines, you can give yourself a little bit more leeway when it comes to entering your trades. Trend channels are slightly different, of course, when you can actually put it on the upper and lower end. So you give yourself an area of support. So down here would be support. That is support for the price. And then you can draw a trend line of resistance as well. That's when the price goes up. So we can definitely draw this trend line. I will probably connect these two. This will give you an idea of where the price may actually find some resistance and stop the up move. You can see a very messy point here. That just happens with trend lines, unfortunately. You're never going to get a perfect trend line, but like I said, you can actually just draw a second trend line as a channel, maybe 1% or so to the upper or lower level of your first trend line, and then give yourself an area that you might want to trade in. As a swing trader, you would have done really well to just sell at these points. So you could have sold here, bought back in, sold when it got to maybe this level, bought back in. Drawing these trend lines on the chart, you would have probably expected that the chart would have bounced off this level, got up here, and then found resistance once more, and that's exactly what happened. Now, of course, this move didn't materialize again up here, and I'll get onto some of the limitations of trend lines and technical analysis towards the end of the video. Next up, I want to talk about support and resistance. What is support and resistance? Support is when prices fall, and you want to find somewhere where the price falls and then possibly bounces back off that, and I can show you that on the chart. Resistance is to the upper end, so if prices are going up, where will they find resistance? Where will they actually stop going up and maybe be sold into, ending the run going up? So let's just draw some lines of resistance on the chart. This was definitely a line of resistance here because it signaled the end of that upper move. We can also see a resistance line here, and we can see a resistance right here as well. When you draw resistance lines though, what you're really looking to do is find large areas of trade in the chart. So what I'm actually going to do is draw a resistance line right here. You can see that it has confirmation in trade a lot of times. We have a lot of trade around here, a lot of trade here, and a lot of trade here. So that could definitely be a line of resistance for us. What you want to do is really find the biggest areas of support and resistance. I can definitely see a line of support and resistance around this level. It's not going to be perfect, but I can see around about this level as there is a lot of trade. So you can see that there's a lot of trade around this level and around this level. So what you can do once more is actually put another trend, another area of resistance and support here, just like we drew those trend lines, to give yourself a better chance at entering into trades. It does look a little bit messy, so I'm just going to delete that one. But you can certainly see right now on the Bitcoin chart that the price is testing this support. It was actually resistance right here. So on the move up, we got a lot of resistance around this level before it moved up. And again, on the move up, we got a lot of resistance around this level before another move up. So that is resistance, but to the downside, that resistance can turn into support. Now we do see this as a major level. So let's just put it around about this price. It's very difficult to actually put it on. Charts never trade perfectly, but now on the downside, when Bitcoin is coming down, you expect this level as an area of support. What that means is that you might get a lot of trade around this price, and it's actually a significant price level around 49,000-50,000 in Bitcoin. If Bitcoin breaks through this level of support, we can actually see it moving further down to the next level of trade, and that would actually be around here. You can definitely see some support and resistance around this level. So there was some sell-offs here and it actually bounced off here, and then another area of trade down at this level. So that would be the next level of support. And then looking down further, you would obviously see this as an area as well. That was an area where the trade actually consolidated a little bit around here, consolidated again, and then had a couple of days of trade before it moved up. So that is how you draw levels of support and resistance on the chart. Again, can't be perfect ever on a real chart, but when people give you price predictions, this is essentially what they're doing, looking for levels of the chart where trade has consolidated previously. Next up, we've got chart patterns, and this is a classic chart pattern called a head and shoulders pattern. It's going to be very difficult to show you on the Bitcoin chart. You could potentially say that actually this was a head and shoulders. You had 1, 2, 3 breakouts here with trade, but head and shoulders pattern, it's a very difficult pattern to get into, but essentially what you have here is a left shoulder, a right shoulder, and then the head in the head and shoulders pattern. So you can look at this to try and predict future prices. So on the left-hand shoulder, what you can see is consolidation and resistance around a certain level, and then a slight move down off the back of that. what you then have is another move to the upside, and you get the head of the head and shoulders pattern. So once more, we have kind of a level of a range around here that it trades at. That move also breaks down a little bit. And then what you get is the right hand shoulder. And the right hand shoulder is really important because what this is essentially saying is we had prices move up. Sellers came in and moved the price down. So they sort of rejected that move at this price level. Then buyers came in once more and tried to have the level around here. Again, sellers came in and rejected that price level. Now on the subsequent move up, what is going to happen to the price? Is the price actually going to move higher than this head, or is it not going to reach that head? And you see the right shoulder actually comes in at a lower high than the head of the head and shoulders pattern. That's a bearish move. It tells me that even though buyers are trying to push this price up, sellers are not allowing them to, and they're not allowing them to move the price at a level that we got in the head. And so this means that essentially the price and sellers may actually be winning overall, and the price actually must move a bit lower if the head and shoulders pattern actually plays out. It's difficult to actually find this on the Bitcoin chart. I'm sure I could, but there's potential head and shoulders here. You have the move up and down, buyers pushing up a little bit down, and then you have a slight head and shoulders pattern right here that's not as high, but you did have higher highs here, and so it's not the best head and shoulders pattern for sure. There are many types of chart pattern that we can discuss. Another one is the bullish triangle or the ascending triangle. These have happened in Bitcoin a lot. What you'll see is an uptrend. So buyers pushing the price up, sellers pushing the price down. But as you can see, every time a seller comes in, they push the price down to a higher amount. So this is what is called higher lows. You can see the low on each trade is actually getting higher over time. So sellers are coming in, pushing down, but each time they're not able to push the price down as much as before. But also you can see that the high price isn't actually rising. This is what breakout traders will look at. So buyers are happy to buy cryptocurrency around this level, and sellers are coming in, selling their cryptocurrencies. But more and more buyers are flooding in all the time, and that's why they're not getting cheaper cryptocurrency. More buyers are coming in, meaning that the price actually is rising overall. And a breakout trader will love this pattern because what it means is that the supply of cryptocurrency is drying up. The cryptocurrency around this price right here is just simply gone, and they're having to pay ever higher prices rising. And eventually this trend must break and you get a breakout. So breakout traders will enter into a trade around about here and actually go long here because it's an ascending bullish triangle, hoping for a breakout in the trade. This essentially means that sellers just don't want to sell any cryptocurrency here, and that buyers are running out of cryptocurrency to buy. And so they've got no choice other than to just pay more money for their buys. Another chart pattern would be the rectangle or the consolidation phase. Again, breakout traders use these as areas to place trades. You have to work out whether you think the breakout is going to be to the upside or the downside. But a rectangle or consolidation is a period where many candlesticks and time periods move where the price hasn't really changed. What this means is that there's an equilibrium between traders. So buyers and sellers are coming in and not really pushing the price either way. And traders definitely believe that when consolidation happens, there will be a breakout in that consolidation when one of the sides actually wins, one of the sides' orders dries up, and then obviously you'll get a breakout of that range. Breakout traders do this all the time. We can see that on the Bitcoin chart. Certainly there is an area of consolidation around this level. So we can see on the chart right here, this is definitely an area of consolidation. After a big move to the downside that we had right here, this area of consolidation is a good place for breakout traders to place their trades. Now we know that at this specific time in Bitcoin, macro news and events is driving asset prices lower across the board in the stock market. Cryptocurrency is going to be the same. We also have the 50-day moving average moving below the 200-day moving average. A pretty bearish sign overall. So consolidation traders and breakout traders may actually place some short bets here during this consolidation phase. I've got a video actually going through breakout trading and what that is and how to place trades, so definitely go and watch that if you want. But essentially breakout traders will use these consolidation patterns to enter into some trades, set a stop loss just above the consolidation, and then enter their trade hoping for a breakout, which is exactly what happened here. And you can see that breakout was actually 13%. So a breakout trader going short there would have made a very decent day trade. Next up, I just want to highlight what the moving average or the simple moving average is that I've talked about a lot, and I talked about just here with the 200-day and the 50-day moving average. So what exactly does that mean? Well, the moving average is really simple. I suggest Investopedia to learn about this stuff. But a simple moving average calculates the average of a selected range of prices, usually closing prices, by the number of periods in that range. In plain English, you just get an average of the prices over time. A 50-day moving average or a 50-period moving average takes the closing price of the last 50 periods and makes it an average and plots it as a line on the chart. What this aims to do is smooth out the price moves over time. And what's great about moving averages is that you can compare them. So this blue line is the 200 period and this red line is the 50 period. A lot of traders use these to enter into trades. So what they will actually do is say, well, look at this 50 period moving average. It's moved way below the 200 period. What's that actually telling me? It's telling me that short term, there is a bearish move in the price. That's exactly what has happened. So what a lot of people do is actually use this as a trigger. So as soon as that 50 period moves across the 200 period, people will actually go into trades going short because they think that this move will continue. And that's exactly what happened during this time. Again, this links up exactly well with that consolidation phase and breakout trading to the downside. So a lot of traders will place stop losses around this level, saying that it may move back up and that's fine. So I'll take my loss if that does happen, but I can also try and take advantage of a breakout to the downside. So this is a classic setup for day traders, and any day trader worth his salt would definitely have gone into that short trade there. Everything just pointing towards that breakout to the downside. Next up, I want to talk about the RSI, or the Relative Strength Index. As you can see here, the Relative Strength Index, RSI, is a momentum indicator. So this tells you about the momentum of a move overall. It does not tell you where prices will go, of course, but just the momentum of a price move, which is really important for traders. You can see that RSI around a value of 70 or above indicates that a security is becoming overbought or overvalued. An RSI reading of 30 or below indicates an oversold or undervalued position. This is only a guide for traders, but let's see how we get it on the chart. So I'm going to come up to the chart right here, and I'm going to go to indicators right here and type RSI. Relative Strength Index comes up, so I'm going to click that, and then we see it come at the bottom. I'm just going to change the style right here because we can't see anything for right now. All right, so I changed the RSI right here. So what is it telling us? So anything above 70 is overbought or a very high price comparatively. And that tells us that the strength of the move isn't great. So as you can see, there's definitely high RSI. You can see that white line. So that would be the high RSI. So around here, the RSI is pretty high, and the RSI here. So you can see that at these times and at these levels, it may not be the best time to go and actually trade a cryptocurrency. Now, it just so happens that we can see that these periods of the RSI being very high just happen to correlate with the price of Bitcoin moving to very, very high levels. That is definitely not the best overall. So you can see that you definitely don't want to be buying in at these levels. Now, this is what retail investors classically do. They buy on hype and FOMO. They think it's going higher. They just don't want to miss out this move. And so they end up buying at these levels. And you can see how different it is to buy at these levels as compared to when the RSI is down at low levels. And it just so happens that the RSI being down here around 40 just corresponds with these lower levels and sell-offs. With Bitcoin's big move down here with the rest of the market, you can see a big sell-off right here. Now, if you are a long-term investor, you can really just look at the RSI straight away, and you can basically save yourself about 20% every time you buy Bitcoin or another crypto. Instead of buying up here at these FOMO levels, just buy when the RSI is down, and you can see you can save yourself literally 15-20% on each of your buys. It isn't that easy, of course, because the Relative Strength Index doesn't tell us where the price will go. I mean, it can be up here and it can just move higher from there. So the RSI would be a wrong indicator to use in that instance. And that goes for every part of technical analysis. It only tells us what happened in the future comparatively. Next up though is Bollinger Bands. Bollinger Bands are something that pro traders use all the time. What exactly are Bollinger Bands? You can see it's a set of trend lines plotted 2 standard deviations, both positively and negatively, away from a simple moving average in the middle. And it works off the assumption that prices always fall within 2 standard deviations of the mean. You can go and see a classic bell curve as an example of that. We're going to come right here. We're going to put Bollinger Bands on. So I'm going to go over here, just type in Bollinger. We can put those Bollinger Bands on right now. Then we're going to change how they look. And I just want to take the other moving averages off because we don't need to see them anymore. So now we have 3 lines. We have the red line in the middle, which is the 12-day moving average. Then we have the upper and lower Bollinger Bands. Over 90% of the chart and prices will move between the upper and lower Bollinger Bands. Traders will often use the Bollinger Bands to look at areas where they will want to trade, place their orders, and also place their stops. So what we can see right here at this level is that there's a consolidation phase and potentially a breakout, and it is towards the bottom of the Bollinger Band. If you're a swing trader and you're wanting to go long, then you might want to wait for the chart to come back to the bottom Bollinger Band. And obviously when prices are high and towards the top of the Bollinger Band, it could mean that the chart may actually come back towards the center line or even the bottom Bollinger Band as it trades. Traders can often use the Bollinger Bands as areas to put their stop losses as well. So let's say you actually wanted to go long around this level, you're going to look at the Bollinger Band coming down here and actually place a stop loss around another area of support. So this was definitely an area of support that you might want to put a stop loss in. Traders also use Bollinger Bands as an area for a breakout trade, and you can see that exactly right here. So this is an area of consolidation. As you can see, we've talked about consolidation and rectangle or consolidation chart patterns. You can see that the Bollinger Bands are actually narrowing here, getting closer to each other. The range is a lot closer than other times. You can see the range here is actually very wide. What happens when there is consolidation, especially if you're trading breakouts, is that this consolidation phase and the narrowing of the Bollinger Bands may actually go to a much wider or a breakout and a widening of the Bollinger Bands. That's exactly what happened over here. As you can see, we can see that the Bollinger Bands have widened significantly. Now, a downside of the Bollinger Bands is that it can't tell you which way the breakout will be. And actually the Bollinger Bands are very backward looking. You'll see that essentially the Bollinger Bands just get wider when volatility increases and get narrower when volatility decreases. So talking about that limitation, let's come on to the limitations of technical analysis. TA completely disregards news and events. Macro market news, economic news, employment figures, national debt figures, GDP figures, all of this moves markets, and technical analysis cannot predict that. It is only backwards looking on the price that has occurred before. Sentiment in the markets changes daily based on news and events. That is something that technical analysis also cannot predict. You also get a lot of mixed signals with technical analysis on a lot of occasions. You can use these as a guide. The RSI can be very high. That's not to say that the price can't move up though. And the more indicators you use, the more confused you may be in terms of what they're actually telling you. Technical analysis is only backward looking and cannot predict the future. And technical analysis cannot work in all scenarios. That is why fundamental analysis of markets and the future of policy decisions and how economies grow, but also specifically towards crypto projects, is really, really important and cannot be underestimated. If you want to know more about trading cryptocurrencies, then check out the crypto trading playlist on the channel. Check out the description for some other helpful videos and resources too. Make sure to subscribe for daily helpful crypto content, and I'll see you in the next one.